Hi, everyone, and welcome to the July 2025 edition of the Knowledge Shop Monthly Tax Roundup, where we keep you on top of the latest developments that matter to you and your clients. I'm joined today by Mike and Anne, and this month we're diving into two big areas of ATO activity: the GST rules for cross-border transactions and the continued compliance pressure on controlled foreign companies, or CFCs. We'll be looking at what's changed, how the ATO is approaching these issues, and what advisors need to be aware of from a practical perspective. First up, Mike joins us to walk us through a series of new ATO rulings that clarify how the GST rules apply to cross-border transactions. These rulings could have a real impact on how you determine whether GST applies to services provided to overseas clients. Mike, the ATO has issued some new rulings on the way the GST rules apply to cross-border transactions. What specific issues do these rulings address?
Yeah, the ATO has released two updated rulings which deal with cross-border implications around GST, which is quite a tricky area of the system. Now, these two rulings replace some older rulings, so it's really the ATO refreshing its guidance in these areas and really looking at the issue of whether a supply of something other than goods or real property, so typically we'd be dealing with this in the context of, say, services, can be GST-free under the export rules. And we find those rules in Section 38-190 of the GST Act. Now, as I said, there's two rulings that have been released. First one, GSTR 2025/1, deals with item 2 of the table in that provision. And basically what that provision says is that a supply made to a non-resident who's not in Australia in connection with that supply can potentially be GST-free if certain conditions are met. What this first ruling deals with specifically is actually an exception to that rule. So if you make a supply to a non-resident who's not in Australia in connection with that supply, it won't necessarily be GST-free because, for example, if you are required to supply something to an entity here in Australia, that can negate the GST-free treatment, but only in some cases. And so what the ruling looks at is that exception. So have you actually been required to make a supply to another entity in Australia? And some of the exceptions to that exception, which is getting a bit confusing. So for example, let's say we enter into an agreement to provide some services with a non-resident entity that doesn't have a physical presence here in Australia, no branch, no employees in Australia. But under the agreement, we need to do something for an entity here in Australia. Now, on the face of it, the exception to the rule would suggest that we don't get GST-free treatment. However, it's more complex than that because if that Australian entity carries on an enterprise, that Australian entity is registered for GST in its own right, and if that Australian entity would be able to claim back the GST credits anyway, then our supply can potentially be GST-free. As you can see, it's a complex area of the rules. This is why we have detailed guidance like this from the ATO to help us navigate those provisions. The second ruling, GSTR 2025/2, deals with item 3 of the table in 38-190. Item 3 basically says that a supply can be GST-free if it doesn't relate to goods or real property. So a supply of services, for example, it's made to a recipient who's not in Australia, and the effective use and enjoyment of the supply is basically enjoyed outside Australia. Now, if we think back to the policy of GST, it's really about the consumption of goods and services in Australia. So a lot of these rules are really about trying to leave supplies out of the GST system where consumption happens overseas. Now, this item, as I said, it's looking at whether the recipient is outside Australia and whether that effective use and enjoyment is outside Australia. However, we have some provisions in the legislation which expand the scope of that GST-free treatment. So if you enter into an agreement with, for example, an Australian entity to provide something that might be used and enjoyed overseas, that could still be GST-free if the agreement or the arrangement requires you to provide the supply to someone based overseas. So it's almost the opposite of what we look at in item 2, where we're negating GST-free treatment with some exceptions. This one is expanding the scope of the rules to allow GST-free treatment to apply in a broader range of situations. Once again, it's a pretty complex area. This ruling goes through that complexity, walks us through the technical analysis, but also with some practical examples as well. So we've got some updated GST rulings. There are other GST rulings out there that deal with other specific aspects of these export rules. But these are refreshed rulings that give us, I guess, some up-to-date guidance and commentary from the ATO to help us work through what are some pretty complex provisions.
If we take a step back and think about these from a practical perspective, how will we normally go about determining whether GST applies when invoices are issued for services that have been provided to customers based overseas?
When we're dealing with a client who has some cross-border dealings, particularly where that relates to services or the provision of intangible rights, there certainly is a process that we would work through in trying to determine whether that supply could be GST-free under the export rules. And again, just a reminder, the key provision we're looking at here is 38-190 of the GST Act. Now, what we're really looking at is a table in that provision, and there's a number of items in that table. And if the supply that our client is making falls within the scope of any of those items, it should be GST-free. So it's really a matter of working through those items step by step until we find the one that gives us the GST-free treatment. We only really need to satisfy one of those items, so the fact that we fail the other items isn't necessarily a problem as long as we can pass one of them. Now, let's keep it at a very practical level in terms of how we might work through this process. We'd normally start with item 1. It's a pretty good place to start. Item 1 basically looks at whether the supply you've made is directly connected with goods or real property located overseas. So we're looking at a very strong connection with something physical that is outside Australia. So you might have a client who is a builder and they're engaged to go and assist with a building project overseas somewhere. The work they're doing physically relates to something overseas. It's probably going to be GST-free, regardless of whether their customer, the person who's paying them, is an Australian resident or not. Now, item 2, we've already talked about a little bit previously. Item 2 looks at whether we're making a supply to a non-resident who's not in Australia in connection with that supply and where certain other conditions are met. So this item actually requires us to analyse the residency status of the other party. That won't always be an easy thing to do. Residency issues are pretty complex in their own right. But if we're pretty confident that the arrangement or the agreement is with a non-resident and we're not required to do something for an entity here in Australia, then we might find we can get GST-free treatment that way. Now, as we saw earlier, it's more complicated than that. Just because you are required to do something for an entity here in Australia doesn't necessarily mean you lose the GST-free treatment, but we're getting into more complex territory. The third item looks at that effective use and enjoyment. Again, we talked about this a little bit earlier. Have we made a supply to a recipient who's outside Australia, and is the effective use and enjoyment outside Australia? Bearing in mind, of course, those extra provisions that expand the scope of the rules where we're required to make the supply to someone who's outside Australia. A really good example of that item is where, for example, we might be running a training business and we're engaged by an Australian company to train some of its employees. So item 2 probably won't work because we're engaged by a resident entity, but we'd be looking at item 3. Have we made the supply to a recipient who's outside Australia, and is the effective use and enjoyment outside Australia? Well, if we are required to provide that training overseas to some employees of the company who are physically located overseas at that time, well, ATO guidance suggests that we are making a supply to someone who's overseas, and the effective use and enjoyment of those training services happens while they're overseas. That can potentially be GST-free. So you can see that providing a supply or making a supply under a contract with an Australian resident entity doesn't necessarily mean you can't get GST-free treatment. We need to look beyond just the other party to the arrangement. We need to look at the location of, for example, the people who are using and enjoying the supply that is being made. The fourth item looks at specifically supplies of rights. So often we'd be looking at intangible assets and where we're providing some sort of right in connection with those assets. Now, there's a couple of different ways that we can get GST-free treatment. One of those is where the supply is of rights, and those rights are to be used outside Australia. So an Australian entity might hold some sort of intangible asset, intellectual property, for example. They might grant a license to a foreign entity and where the license agreement restricts that foreign entity and ensures that they can only take advantage of that right, exploit that right outside Australia. So we're supplying a right, it's for use outside Australia. Often we will end up with GST-free treatment. So at a practical level, that's the process we would often work through. Where you start doesn't really matter so much. Start with the one that seems to be the most applicable item. But it's a matter of just working your way through those items and looking at whether any of them could possibly apply. If so, you might find your client is making a GST-free supply under the export rules. Now remember, one of the good things about making a GST-free supply is even though you don't have a GST liability, you will normally still be able to claim back GST credits. So if you are an Australian business, you're incurring expenses here in Australia in connection with the supplies that you're making, you'll often still be able to claim back GST credits for those expenses, even though the supply you are making doesn't trigger a GST liability. So you don't have to pay the GST on the supply, you still get to claim the GST credits on the expenses you're incurring in running your business. One of those real great advantages of making a GST-free supply compared with making a supply that's input taxed. So cross-border GST transactions can be a very complex area, but there are ways we can kind of step back and look at that from a more simplified point of view, a practical point of view, and work through it to try and get that outcome that we're looking for.
Thanks, Mike. Now, let's shift focus to a long-standing but still a very relevant area, the CFC rules. The ATO has noticed a high error rate for private groups in their CFC disclosures, which remains a focus area for the ATO. And what are the CFC rules and what are some of the ATO's concerns?
Thanks, Amy. So at a very high level, Australian resident taxpayers must apply the CFC provisions if they have a controlling interest in a foreign company. The CFC rules will sometimes operate so that a resident taxpayer needs to include some or all of the foreign company's income in their Australian tax return, even if no dividends have been paid. Australian taxpayers with interests in CFCs need to disclose all CFCs and the relevant income amounts in their tax returns and the IDS. So recently, the ATO has been noticing some common errors with disclosures by private groups in this area. So this includes taxpayers underreporting of their CFC attributable income in their tax returns, often from errors in applying the active income test or from failing to recognise tainted income. In addition, they've noticed taxpayers emitting deemed dividends from unlisted country CFCs, incorrect IDS disclosures, including completely overlooking CFCs where there's associate inclusive control, and inaccurate reporting of CFC gross revenue and the number of CFCs acquired and disposed of. So the ATO recommends that tax practitioners regularly discuss the CFC provisions with their clients and encourage their clients to keep them in the loop about all their business developments. This is because even when small changes to the structure occur, this could result in changes to their disclosure obligations. So for example, where a client sets up a foreign company without informing you, it can be easy to overlook their disclosure obligations under the CFC rules. Even if the company is set up for genuine business reasons, the CFC rules can apply even where there's no tax avoidance motive. Where something has been missed, it's recommended to amend any previously lodged tax returns if you discover the error to avoid penalties and interest. As this is a focus area of the ATO's tax avoidance task force, it's important that your client's disclosures are correct, as review processes can be lengthy and costly.
Thanks, Sam. The CFC rules do sound complex. Can you give us a high-level rundown of the rules?
Thanks, Amy. So while these rules are very complicated and require detailed analysis, at a high level, the CFC rules apply to Australian residents who are substantial shareholders in non-resident companies that are a CFC. So the provisions basically operate to include or attribute a share of the specified income and gains of a CFC as the Australian taxpayer's assessable income. And there are broadly 4 steps that we generally go through. So as the first step, the starting point is to determine whether the relevant company is a CFC. So this requires passing one of the 3 control tests. The first one being a non-resident company is a CFC if a group of 5 or fewer Australian entities with at least a 1% interest together with their associates hold a 50% or greater interest in the company. So if this isn't passed, you would then look at the other 2 control tests. For step 2, if you determine that a non-resident company passes the control test and is a CFC, then the next thing to note is that the CFC regime applies only to Australian residents who are substantial shareholders or attributable taxpayers. A client will normally be an attributable taxpayer in relation to a CFC where they, together with associates, have a minimum 10% or greater interest in the company. After determining that the foreign company is a CFC, then the next step is to apply the active income test. The purpose of this test is to determine whether the CFC is engaged in active business operations. If the foreign company passes the active income test, then most of the CFC rules do not apply. However, if the CFC fails the active income test, then the attributable taxpayers can be taxed on their share of the CFC's adjusted tainted income. So as step 4, you then need to work out the attributable income of the CFC, if any, for that year. As a general rule, Australian shareholders are taxed on certain income and gains derived by a CFC if the company fails the active income test. However, even if the company passes the active income test, there are certain types of income that are always attributable to the company's attributable taxpayers. So you would also need to check whether the CFC is a resident of a listed or unlisted country, as that impacts what income is attributed. There are broadly 7 listed countries, which are those that have comparable tax systems to Australia. So overall, it's very important to work through the CFC rules in detail, and you separately need to check whether each foreign subsidiary company is classified as a CFC of the client.
Thanks, Anne. Can you also talk us through some other practical things to look out for?
Firstly, before looking at the CFC rules, we would also be checking whether the companies could actually be treated as residents of Australia for tax purposes. This is because if the company is actually a resident of Australia, then the CFC rules shouldn't apply. A company incorporated overseas can be treated as a resident of Australia if it carries on business in Australia and either its central management and control is in Australia or its voting power is controlled by Australian residents. In particular, in recent years, the case law seems to suggest that it's actually easier for a company to be classified as a resident of Australia than what the ATO had previously indicated in the past. Next, as mentioned earlier, the CFC rules also attribute income differently, depending on if a company is a resident of a listed or unlisted country. So in general, if the CFC is a resident of an unlisted country and it fails the active income test, for example, because it earns 5% or more of its income from passive or tainted sources, then the CFC's tainted income is attributable income. However, if a CFC is a resident in a listed country, a narrower range of tainted income is attributed, even if the CFC fails the active income test. The policy behind this is that the listed countries have comparable tax systems to Australia, so there isn't expected to be any tax benefit to setting up a company in those countries. And another thing to note is that where the CFC rules do apply to attribute income, when that income is later repatriated, there shouldn't be any double taxation. So what that means is that any dividend income that the Australian client later receives from the profits that were attributed should be exempt from any further Australian tax and not assessable.
Thanks, Mike and Anne, for those practical insights on GST and cross-border transactions and the key takeaways around CFC disclosure obligations. Now, that's it for our July tax roundup. The ATO's focus on these areas is a timely reminder that international dealings can carry real compliance risks, even for private groups. Now, if you're not yet a Knowledge Shop member, now is a great time to see how we can support you and your team. Membership gives you access to the help desk for technical guidance on tax, accounting, super, and more, plus a comprehensive work paper knowledge base and CPD resources. If you're interested to see how it works, do reach out for a demo. We'd love to show you how we can make your practice life easier. Thank you for joining us and see you next time.